Reminder everyone, everything today in this video is for educational and information purposes only. Please check with your financial advisor before doing any of these kinds of trades and following any of these ideas. Morning everyone. So just wanted to drop a video on some of my thoughts, what I'm looking at out there in the vol space and the option space. And we're going to talk about some trades in a moment, so bear with me. I just wanted to give you a little bit of an overview. So what have we had? Well, we've had a very, very high VIX. And so we can see that the level of fear and the level of option pricing is quite divergent from the level of actual volatility in markets. You can see that we're trying to sell off at times, but we just can't do it and we keep bouncing back. There's quite a bit of gamma around that's keeping us stuck in a range, kind of like we were in with that JPM collar, and I'll show you how that works in a moment. But right now we have this big between what's happening and what people are worried about. And there are some good reasons for that out there. I'm not saying there aren't, but something's got to give here, right? Either we're going to start moving around a lot more, and that could mean to the upside. We could have just a massive melt up, and that would be volatility as well, right? Upside volatility is a thing, right? It doesn't have to be volatility, or the volatility market's got to come in. The VIX has got to probably going to hang in there just because of what happened in August, early September. People are fearful. A lot of desks were unprepared for that. They were under hedged, right? We saw that very, very low skew, multi-year low skews in sort of that shorter range, 3 to 6 months. And so people were under hedged, and now, as I kind of said right here, take a look at this slide. Folks were under hedged, now they're over hedged, right? So they've gone, obviously some risk department said, hey guys, listen, you can't be under hedged, you've got to have some hedges on. And this always happens in cycles, right? People just eventually give up on hedging and they just go long. And then every now and then in August will happen, although that was quite unusual, an August situation will happen and everybody goes, oh yeah, now I remember about protection. Now I remember about the importance of having some hedges. So everyone kind of piled into hedges, VIX 65, you guys know the story. So now they're really, really hedged and the skew's very, very high, which isn't to me a reason to be bearish. It's just people are going to stay long stocks, but they're owning protection at whatever price it is. It just that, you know, sometimes you have no choice. If you're mandated or being forced to buy protection, if you're a little bit fearful, whatever, you're going to pay whatever it is for your house insurance, right? Because you got to have house insurance at times, right? Especially after what happened a few months ago. So we have the situation where we're kind of seeing this gamma profile. When I say gamma, don't get too worried about that. I don't want to confuse everyone, but basically know that it means one of two things. Positive gamma means less volatility. Negative, as shown, it means acceleration of movement. So that means if we get down past that 5,600, 65, we could get an acceleration as participants into sell-offs, and then we get all kinds of other things, synthetic gamma. There's all kinds of accelerants out there that didn't used to really exist in the size that they do today, right? As I've been saying for a couple of months, the tail and the dog, right? It used to be that the market was the dog, the options were the tail. And I've been saying, listen, at some point we're going to get to a point where the options market is really the dog, right? And so it's become massive, and so these are things you've got to pay attention to. I'm not saying focus solely on them, but pay attention to. So right now we're in this positive gamma regime where we get little sell-offs and we're gonna have buyers, right? The dealers who are hedging are going to buy. I do the market maker for a dozen years, so this is exactly what I used to do. Market comes off, I'm positive gamma, I'm buying futures, I'm buying stock, I'm supportive of markets. Same thing when markets rally. You're going to have a little bit of resistance from that supply of stock. I'm going to do another video later on or tomorrow just talking about how that evolves through time, because as we sort of approach this upper bound of positive gamma. Now this situation is changing all the time too, so you want some tools that can take care of that, or you want somebody like me kind of keeping you informed as to what's going on. But this is an evolving landscape, of course, and we're going to see a lot of gamma come off this week during expiry week, and we've yet to, it remains to be seen what we see reloaded for next week, right? So some of those positions are going to be rolled, some aren't. We'll have to see how that works out. But if we can get up a little bit higher, there's this potential for a short gamma pocket. It's not massive, but it is something that coincides with the 6,000 level on the S&P, which I think is a magnet in itself. you've got this JPM collar up around 60.20, and that's the big position that we talked about before that acted as kind of a magnet for lack of volatility when we ended up there during that particular period around September expiry. As time goes on, we have something called charm. We have Vanna potentially if vol comes off, and then charm, which means the passage of time reduces the delta. So anybody hedging has to start, being less aggressive on the hedging, and then eventually start buying back hedges as you get close to that level. So that's the video for later. We're gonna get into that a little bit more. But right now, know that things are very hedged. People are very hedged, and that's also an advantage as well, right? When everyone's hedged, even though it's expensive hedging, they can be more emboldened to stay long stocks, right? But what else do we have going on here? Well, let's take a look. We've got the corporate buyback window that is actually opening up pretty soon as well. So here we go. We had this corporate buyback window that helped to push stocks up into kind of that September period that we had some positive flow from corporates buying back their own stock. We know that that's a big thing these days. Companies like Apple have nothing better to do than buy back their own stock. They're not really innovating anymore. They have tons of cash, so they're like, well, okay, let's buy back our stock, even though it's not particularly cheap. So it is what it is. This is our new world. Everybody wants their stocks to go up and be rich. So it's good for executives, it's good for shareholders. So we shouldn't complain as shareholders. But we have this window opening up again around October 25th, where this is their best 2-month period for executions of the year. So we get very, very big buying again. And what I want to add to that is this particular flow here. So CTA flows, which is kind of, we've sort of thought of it as, commodity trading flows, but it's really everything now, right? It's not just as all kinds of various strategies where the flows can influence markets. And so over the next week, we have a little bit of selling to the downside if we do get down. Remember, I talked about that accelerant, right? There's always a possibility that if we get some sort of reason to sell off, that could snowball into a bigger reason to sell off more. You always need that spark, right? You've got this sort of kindling here, but you still need the spark that lights the kindling on fire. Right now, we don't have that spark. We're unable to get markets down, so markets kind of sitting around and thinking about that end of year natural seasonal push, right? Those are very powerful things. The economy is good. All this other stuff that I always talk about, things are really, really good. And so, the market likes a little bit of inflation, a little bit of growth, and that means things are generally okay. So if we see things move to extremes on the employment side, on the inflation side, on the growth side, we see things move to extremes, then the market has something to worry about. But right now that porridge is really, really warm. So back to our flows. After this week, we're going to kind of see that we have more and more stock to buy from these CTAs. So, but more to sell as well. So we create this kind of two sides of the coin situation where whatever happens, in a flat tape, there's stock to buy. In an up tape, there's even more to buy. And in a down tape, we have even more to sell, some big, big flows to sell. So we end up with this, okay, either we're going up or we could potentially move to the downside very, very aggressively. So we have to just be cognizant of that. I'm a big fan of staying long, but with hedges. So in the community at LaDuc and in my own community, we're talking about hedges. I'm looking at some upside VIX hedges, looking at some downside QQQ hedges, because I think there's a little bit of weakness in that tech area. We had some good numbers from TSM today. That's going to alleviate some of the concern that ASML really, really dropped on this market. It dropped it hard 2 days ago. NVIDIA bounced back, and I talked a little bit about in my tweets about how maybe we're getting a sort of bifurcated market on the semi side where some names are going to be doing well and some names won't, whereas before when it was just AI frenzy, it kind of lifted all boats. But now we're back to this point, not back to this point, but we're maybe be a little bit more choosy, and names like NVIDIA that capitalize on the secular forces of AI can maybe do a little bit better and suck up some of the money that's been going into the cyclical side of things. Now, which would be ASML, maybe Micron to some extent. I don't know. Maybe we get a little bit of that money from those crappier positions as well, maybe moving into the fewer names that are actually doing well. So that could potentially act as fuel for NVIDIA, which we've been talking about has kind of very nice upside skew potential. I can definitely see this thing rallying into the end of the year, making all-time highs and going a little bit. So very interesting trades that we can put on there. So let's talk about, and then here's another version of the CTA kind of world. It's called vol targeting. So we've had very high 3-month volatility based on what happened in August and what happened a little bit in September. We've kind of got this pocket of longer, slightly longer term volatility that's very high. We have volatility in the short term plunge. We know nothing much has been happening lately. So as this sort of longer term volatility starts to come down, as you see this arrow, as this starts to converge towards, if nothing bad happens, if this converges towards those lower levels of volatility that we're facing in reality right now, right? This is more reflective of reality than this is reflecting that event risk that we had in the late summer. And so this comes down, and then that actually starts to fuel some more buying from strategies that look at at low volatility. When there's low volatility, guess what they do? They buy more stock, and then look at how that becomes a positive feedback loop. They're buying more stock, and that creates strength and stability in markets, which drives down volatility even more, which as per mandate makes them buy more stock, and so that calms things down more, and buy more stock calms things down more. So you can see how that sort of spirals positive, but it can also spiral to the negative too when we get into those short gamma situations, panic situations, whatever the spark is that lights the fire. Then that can reverse the other side. So don't think this is all champagne and strawberries on the way up. It can be destructive on the way down. And that's why we have these two worlds that I often talk about, this kind of volatility, very high vol, very low vol. Right now we're kind of low vol in the market, but high vol in the VIX. Very unusual market. So just know that this is a really weird market, okay? We've been making money in the community. We've been making money on stocks. We've been making on hedges as well, okay? That is crazy stuff. That's cats and dogs living together. Mass hysteria, as Bill Murray said in Ghostbusters. It's bizarro world, and that's not going to last forever. That's kind of good times if you're positioned like that. Eventually, we're going to get those hedges losing money again, but as stocks go up, that's kind of the primary focus. So lately, we've seen a lot of buying, a lot of huge buys in the SPY upside. Not expensive, right? So I like to say, when everyone's focusing on that left tail, sometimes it's good to look at the right tail. I'm not saying we can't go down, but sometimes as a vol trader, as an options trader, you've got to look at where the edge is. Is the edge to the upside? Well, it's a good trade from an edge standpoint. It may not be always the best trade from what the chart is saying, but I think a lot of things are kind of lining up for things to continue. CTA, you've got vol targeting, you've got generally positive news, you've got a big if from earnings, but so far bank earnings awesome. This is starting to line up to basically this upside is cheap. And guess what happens when they start plowing into the upside? That can normalize. So that cheap vol, you not only make money on direction, meaning you're delta long if you own, say, spin calls and SPY, but that upside kind of gets repriced to normalize a little bit. It's cheap now, but then it pops up a little bit, and you get the benefit of that as well. So interesting things happening there. And then I wanted to show you a couple trades. And just so you know, I'm not always doing kind of fancy trades. We're doing things in the community. You can look at, I've opened my Discord up to 10 people who are really looking to learn and to be part of this amazing ecosystem that we're building in there. And so we do everything, right? We do some cool stuff. We're up massively on some coin positions, CLSK. We're doing well on Amazon, on Uber. Uber's down a little bit today, but massive gains on that position so far. So we're doing all kinds of interesting kinds of positions, but also some basic things too. So I've got a covered call name here at Palo Alto, where I've only been doing calls. I'm not doing anything. It's a name that I love to hold. And what do I want? Well, I want a couple things when I'm selling calls. I don't want to just sell calls into a big rally like this. That doesn't make sense to me, right? This thing is breaking out, looking fantastic. We scalped some calls in here for nice gains around the last earnings report. And but now we're sort of breaking out of this range. This is not where you sell calls. I see people doing that, and I'm curious about why you would do that, because as we know, you sell calls against a position, you're giving up upside potentially, right? And that's what you don't want to do. You don't want to give up that upside unnecessarily. You want to be paid for that. You want to be paid some edge, right? And where does edge come from? Well, it can come from all kinds of places. It can come from a chart. Here's edge showing you the charts breaking out. It can come from volatility. Where's volatility? Is it low? And let's take a look at volatility, for example. Well, here's when Palo Alto was just kind of heading down, drifting down. I was just long stock here, loving the name. Remember, you don't sell puts or trade options on names you don't love, unless you're very, very nimble, and that's fine too. But generally, I'm of the view that we want quality, and that's part of my approach in the Cash Flow Insider system and Crush the Premium, which you can check out in the description below. These are all things that are very, very important to me, so that if I end up owning this stock, I'm not going to lose too much sleep, because I know it's a great stock and a great theme and a great secular theme, etc. But right here, as it's going down, the vol is really, really low. I'm not finding enough edge for my liking to sell options. Now, what happens? It starts to break out. I've got from breakout. Then it starts to get going. And look what happens. This is partially from the broader market, but here we can see volatility start to really, really pick up. And some of this is earnings. So cognizant, I want to sell into earnings, but we've got edge from the chart. And then look what happens. We get up into here. So I'm riding this thing up after scalping calls in here. I'm riding this thing up to a level where I think there's edge again. And where's the edge? Well, here you go. Boom. We've got these old highs from February of this year. That's where it gets up here. And what do I have? Number one, I have edge. Number two, I have volatility edge, because vol is nice and juicy again. So what do? I hammer out some 390 calls in November. Early November, because I don't want to get into the earnings. So I know the vol is not as high there as the earnings vol, but I'm throwing out some calls because I'm combining that view with a technical edge view and the idea that I'm going to lock in some of this that I bought at 320. So now, instead of giving up upside unnecessarily at times, I'm picking a place where I'm willing to give up upside because I'm being paid to do so. I'm not saying I know where this thing's going. It could pop up to 420 tomorrow, and I'm going to give up some of the upside in that position. But I'm looking at this going, okay, I've got a few things kind of moving in my favor. My stars are aligning, my planets are aligning, however you want to put it, and it makes sense to me right now. So I hammered out those calls, and what happens in that particular position. So we go to Meta here. I've been at a position which irritates me because I love this stock, but I've made really great money on it. In one account, I'm just super long. I'm not going to touch it. But in my trading account, this thing has really run. It broke out here, and I was looking at a 600 fly, maybe like a calendar to play this. We had a big 600 call wall. So in the community, I'm going to talk about call walls. I'm going to talk about where gamma is. These are going to give you insights as to where you can look for slight pivot points and reversal points and stuff like that. That's very, very important these days. So you got to have the right tools for that, which I have. So now we hit that call wall. I didn't do anything up there, but now it's coming down. And yesterday, I sold was it yesterday or the day before? I sold the OC25 567 half puts for 590. What does that do? Well, it gets me in, if Meta keeps going down, it gets me in at, and these are shorter term, right? Because I don't want to get into the earnings yet. I'm going to look at earnings when we get to that point to look and see if there's a play. But right now, if Meta keeps going down, I could potentially own Meta down in the low 560s. Well, guess where that is? Right above this trend line where we had this really, really nice breakout. And this is a name I absolutely love. Like, this is one of my AI winners. This is a show me now stock, right? So there are a lot of stocks in the AI world that are show me later. Maybe they can make it work. Maybe they can figure out how to monetize it. They're investing in it. The CapEx is up on this stuff. We're seeing lots of money being spent. Guess who's making money right now? Well, Meta, which I've been telling people to buy since the mid 400s. Meta's doing it now, right? In fact, not just now, they've been doing it for the last 12, 13 years, right? They figure out what we want to buy based on our behavior, based on all the data that they have about us. They've got a couple billion people worth of data in the world. I mean, they are executing on AI now, but guys have been doing it forever, and they're just going to do it better and better and better, and no one else is going to be able to compete on the ad side versus these guys at some point. Snap, whatever you want to go to, these guys are just going to own it all, especially in a downturn, they're going to own it all. So that's that's my kind of fundamental narrative pitch. Doesn't mean it can't go down, right? We could get a re-rating of valuations at some point in this market. Anything can happen. It's the stock market. But right now, I love the name, and I'm willing to sell some puts here around 590. Vols are nice and high, so I'm going to grab that high volatility, and I'm going to look at this technical chart. Again, where's the edge? Well, the edge is here right on the chart. The edge is in my fundamental view of things. The edge is in, I think the NASDAQ can probably hit all-time highs by the year, et cetera, et cetera. So I'm layering my levels of edge, and that's what I want you to do in your trading. So as we go into this earnings season, I'm going to cut the video short before it goes too long. We had some outperformance from straddles. So be careful on earnings plays. We're going to look at some Netflix plays in the community today because I think that's an interesting one. But look at what we've been doing. We've been outperforming owning straddles. So as I teach in my first week of CFI, you got to be careful when you're selling vol and options into earnings events. I know we have some members who love to do it, and they love the excitement. They love they love the giant premiums that you usually get. But generally speaking, we can see that recently we've had long straddles actually outperform buying straddles 5 days ahead of earnings and selling them 1 day after earnings act paid. Now keep in mind, this isn't for one particular play. Any one stock can do anything. This is over a longer period, over many samples, many earnings plays that something like this can work out. You and I can't do 200 or 300 earnings plays, so any one play, but it's still interesting to note that this is happening. These long earnings plays are paying, and I think what makes it more interesting is usually it's right. Usually you get the call side playing well, right? So occasionally you're going to get a stock go against you, but I would play the call side if you absolutely have to, because and some of that is going to be informed by the market we're in. Right now we're a little bit positive on the stock side, a little bit negative on the vol side, so we're a little bit in no man's land. We've seen some misses lately, so but we've also seen some real positives from banks, a few others. So interesting to note. Be careful out there for earnings. Have an awesome day and week, guys, and we'll see you in the next video.